Welcome to the combined October-November market diary for 2023. We are combining these two because I had a very busy October and November and I wasn't able to pump out a video. But I will show exactly what happened in a little bit of a different order than what you are used to. So to start off, let's start off with the end of October. So if we look at the end of October, you will see that we are actually down from the initial cost of trade. So we are down about $2,000 from life of this portfolio, and that was largely due to large losses in both ENBRIDGE and all of my ETFs. The ETFs have been a massive pain point, especially in October when the market was just getting hammered. My dividend yield is also at 3.6%. My annual dividends are at about $1,800 pre-tax. If we look at the quarterly amount for my dividends, they should be up to about $450 a quarter. I'm not unhappy with where October went because October was such a bad month and the earnings seasons did not help any of the larger market. So I'm kind of meh on it. It did present an interesting buying opportunity for two stocks. Those two stocks were ENBRIDGE and ARC. ARC, I bought 92 shares at $18.93 per share. And ENBRIDGE, I bought 5 shares at $32 a share. You can actually see those notated in here as my ARC is now at 300 and my ENBRIDGE is at 205. And you can see the adjusted cost basis is here. ENBRIDGE came slightly down, ARC went slightly up. Now, if we look at the end of November, you'll see there is a large turnaround, but that large turnaround comes at a slightly different cost of trade. If you notice, there's a stock missing, and there's about $7,000 that is not allocated to a stock. So while we are up about $500 in this diagram, you will notice that VOOG growth is gone. So I did sell off VOOG growth for a loss. I took about $141 realized loss when you take into account dividends paid out. But I did sell them at $253 a share. Why did I sell VOOG growth? I was just really, really tired of the continual losses on that. I was not unhappy with VOO. VOO contained almost all of the same stocks as VOO growth. It's just in a different weighted order. So VOO growth has a lot more tech stocks and otherwise, but I had no stomach to hold on to it for the future. I wanted that $7,000 for something else. And at $141, if I invest it in ARC, I make that back up in the dividend in 1 quarter. So I was not unhappy with just waiting because ARC's ex-dividend date is December 14th or 15th. So I wasn't disappointed with waiting to just buy ARC sometime between where I sold this in November and just, getting the dividend payout essentially, which would make up the realized loss here. Now, if we go a little bit here, we can see what the closeout actually was. Now, the annual cost was about 10 basis points for a management fee. So it was my highest costing ETF. And I did sell it essentially for $162 on the share value. It comes out to $141 after you take into account the fact that I got $21 in dividends out of it. So $141 loss, not awful. Now, why am I okay with that? Because with the sold shares, about $7,000 of sold shares, I can reinvest that into ARC, which at the moment, 19.9 is about what I think I can get for it. That will get me to about $173 per quarter with ARC. That makes up for the loss almost entirely in 1 quarter, and I am happy to get out of what I viewed as a bad asset. And plus, it would make ARC give out about a $317 dividend per quarter, which a year would be significant. Now, a quick note is, where did I get the extra $120 for that 7.2K buy-in? Well, I did not buy ARC by the end of this market diary, so by November 31st. So I knew that ENBRIDGE would pay out its dividend on December 1st. So I have about 7.2K to buy into ARC with, and that will give me a good dividend yield. I have it listed at 10.6, but if you actually take that 12,000 divided by 19.7, you'll actually get it to be about 9.910 flat, rounded. So I'm not unhappy with a 10% dividend yield, because a guaranteed 10% growth on a stock where you park 13 grand into, I'm not unhappy with that. I'm not unhappy with that situation. So that's about as much as I'm going to put into ARC. One of my 2024 plans, which I think I'll talk about more in December, is I think I want to work towards getting all of my shares, all of my chosen companies. I want to try to get all of those up to about $10,000 of a cost of trade. So if we look at, rounding up essentially, Ares Capital, we bought at $18.93 per share. My cost basis at this point was about 18.3. So you can see there is a fairly large increase in value since I bought them. ENBRIDGE, on the other hand, we did buy quite low, but that's because we are quite low compared to where I bought her majority of her shares at. So ENBRIDGE is at about 35 at the end of November, and I managed to buy the dip a little bit. I didn't buy that much of ENBRIDGE, but it was enough that we were adding back to it. So you can kind of see between here, we're getting closer to 300 total between these two on profit and loss. I want to get 300 shares total of both of them, or I wanted to get 300 shares total of both of them. That is going to go out the window once I decide to throw another 300 shares into ARC, and I don't know if I'm going to buy into more of ENBRIDGE yet. I'm not entirely thrilled with ENBRIDGE, and I should really do a deep dive on ENBRIDGE, because ENBRIDGE and Exxon have been making interesting plays with how they're diversifying out and how they're dealing with different government regulations on the energy sector. And ENBRIDGE I'm not as thrilled with as Exxon is, but ENBRIDGE did make an interesting play into the U.S. natural gas market, so I'm holding it, but I'm not thrilled with ENBRIDGE. I will probably put another $3,000 into it by the end of 24, but I'm not. The price has to be right, and I want a dollar cost average down from 37, because I think its fair value is somewhere between 34 and 35. Anyways, now for the pain point. When you look at this graph, I sold here. You can see what I bought it at, and 3 days after I sold it, there was massive tech sector news, and VOOG growth jumped because of what was in VOOG growth. As you can see, the day I sold, very large loss. If I had held till the end of November, seeing I wasn't able to buy ARC anyways by the end of November, I could have sold for a slight profit of about $4 a share. I had about 22. It would have been roughly, $88 of profit versus 141 loss. So yeah, kind of annoying, but you can see the dip that I went through for the last 2 months and how much it went down. I figured it was about to have another crash because I was not thrilled with the overall market, especially the tech sector. How wrong I was. So you know what? I take my lumps. Sometimes between Microsoft and Amazon selling for no other reason than just worried about a crash that never came, and VOOG growth, selling it too early just because I was tired of looking at losses and I was at an acceptable exit loss amount. Really, this is my own bad insecurities coming out, and where I should have been buying and holding and not trading. And I still had that trader's mindset, and I'm trying to get over it. That is my own personal growth that I need to work through. But yeah, it did not feel good when I saw that jump a couple days later. So yeah, here is what the premature ejection cost me. And you can see I was out not even 3 months after buying it. I really need to get better at stomaching some of these turbulent stocks. I'm fairly good with the gases. I don't know why I'm good with the gases, but I'm terrible with the ETFs. But it's probably because I got into them from Microsoft and Amazon, and I've been watching those go up, and I just know that I misallocated my funds, and it's just eating at me, and that's probably why. But you know what? What's done is done. I didn't want to be in VOOG growth anyways. I didn't like how much of a management fee there was compared to my other ETFs, so I'm glad to be reallocating that. Now, we did retain some gains because VOO, as I said, contains most of the same stocks that are in VOO growth. It's just not as heavily weighted into the technology sector. And as you can see, on the day that I sold, I was very negative on VOO as well as VOO growth. But because I didn't sell VOO, I held on to it. At end of month, it was slightly positive. The small caps are forever a bane in my existence. It's a very small amount in my portfolio that is dedicated towards the small caps, and for the amount that's there, I've lost money on both of them. I'm not planning on selling them. I'm sure small cap will do better going forward, but for now, small cap is not treating me well, and I'm not going to add to it. I'm not going to buy the dip on this one because I'd rather buy into Microsoft and Amazon before I start adding on to VB and VBK. It's just as simple as that. I need to do more research into what they're actually holding and the companies behind it, and I don't think the diversification into small caps for the sake of diversifying the small caps was worth it. So we'll reevaluate as 2024 goes on, but at this point in the year, it just hurts. So here's the Vanguard trio of what's left. As you can see, VOO growth, total profit loss, $100, which after the $100 loss on small cap growth and the $80, $90 loss on just small cap in general, it's not pretty for the ETFs. So now we're going to look at a tale of two cycles. Walmart, if you can see that drop, Walmart had a very, very, very bad earnings call. And the earnings call wasn't bad because the financials were bad. The earning call was bad because the CEO was honest with the market and said, hey, I think we're heading into a bad consumer spending sector environment, especially going into the holiday season. And he was expecting some lower turnout and lower sales going into Christmas. So far in December, he has been proved so wrong, but because he said it, we see a 7% drop in in Walmart's share price. I'm still up from where I bought it because my average purchase price was $142. I think Walmart is actually worth around that 170, 180 point, but I don't have any more capital put into Walmart at this time, so I can't buy the dip even though I think it is undervalued at the moment. I think this is actually a good buying opportunity if you have the opportunity to buy into it. I'm sure this will start to go up over the holiday season, especially as we are seeing trends in the consumer spend not being as weak as people were fearing in the end of October, middle of November. Because anyone who worked in especially consumer-facing fields saw how bad the end of October was for consumer spending. consumers just did not spend leading up to Black Friday, and it hurt a lot of us, and it hurt a lot of people who had to do earnings calls in the middle of November. And yeah, it turned out that people were just waiting for Black Friday and Cyber Monday deals, and we weren't able to, because of where Walmart was positioned for reporting their earnings, they couldn't have possibly seen that the next couple of days would have been some of their best sale days. So yeah, Exxon, on the other hand, is continuing its ever cyclical grind between 120 and 100. It does this every year. At some point it will hit 120. At some point it will hit like 95. I'm used to it at this point. Between Exxon and ENBRIDGE, I think Exxon has the brighter future because they are investing in, whereas ENBRIDGE, I need to do a better deep dive of this later, and I don't want to say wrong information, but the things that Exxon are investing in, especially after I have looked into their earnings call and some of their other proposed mergers and acquisitions, I prefer Exxon's mergers than I do ENBRIDGE's mergers. I think Exxon has the brighter long-term future. But at the moment, its near-term volatility is just a continual bounce between 120 and 100, and you just have to stomach that if you want to get into Exxon. But it's dividend solid, so you'll at least make money every 3 months, because you're not going to make it unless you sell at 120 every time and rebuy it when it comes back down a month later, because that's its trend. So yeah, the roller coasters are about to enter their climbing period, and at the end of the month, when they were at their lows, this is what we were looking at. Walmart was selling at a $500 profit, and Exxon was about $50 in the red, but Walmart pays out about $20 in dividends every quarter, and Exxon is up there at about $91-ish every quarter. So we'll make up for some of these losses going forward, and I definitely am probably going to add to Walmart for sure. Exxon, I probably won't add anything else to because we're already over 10 grand, and I want to try to get everything to 10 grand before I start adding on to it. Is that the smart thing to do? No, I just want an equal weighted portfolio. That is probably not the smartest thing to do with capital allocation, but I am OCD enough that I just want a equal weighted portfolio. I really should be weighting it based off of their potential long-term average and where I think the price is going to go and which would make me the most amount of money. I just want a good basis in these 6 companies because I've decided these are the 6 companies I want to primarily follow. So is it a smart decision? Let me rephrase this. Is it the most efficient decision? No. Is it the smartest decision? No. Is it a smart decision? Yes. Why? Because I want to have a significant basis in enough companies where if one has a bad cycle, or I don't want all my eggs in one basket where I'm chasing a potential high on 1 or 2 stocks and I don't have the spread between enough stocks where I can weather a couple stocks having a bad quarter, or one company totally failing and for whatever unforeseen reason. I don't think any of these companies will fail or go bankrupt anytime soon. They're all very healthy on the cash side, but I still want to make sure that we're getting that we're seeing. I just want to make sure that we're diversified out enough where I'm not at a higher risk for losing money. Anyways, so Microsoft and Amazon. So Microsoft saw that massive upshoot. Amazon saw that massive upshoot. I only have 5 shares in each, which means I did not make that much money on either of these. This is the whole AI game. This is the Amazon having a great quarter. This is Microsoft doing that weird thing with OpenAI. Like all that is right here out in the open. And Should have been buying when it was cheaper. I just didn't. And now I am just getting a quarter of the gains I should have gotten if I didn't sell. But at least I'm getting 25% because that's still better than zero. As you can see, my Magnificent 2, I'm up about $300 on Microsoft. Could have been, $1,200, but again, I sold, so that's on me. I need to just accept the fact that I made a bad decision. Same thing with Amazon. It's up. It's up about $80 from where I bought it because I only bought 5 shares. So I can't complain when, it goes up like that and I don't have any skin in the game. So that's on me. I need to learn to stop selling and just holding because I'm trying to do a 5-year time horizon, but apparently I am just unable to get out of my trader mindset. So, October. At the beginning of the month, it was worth about $48,000. At the end of the month, it was worth about $48,000. It looks like a $100 gain until you realize I added about $1,740, which means my actual month-over-month loss was about $1,600, which was a 3.3% loss on the month. And it was about a $1,700 loss since I opened the account. So October was bad. It was hard to stomach. Thank God I wasn't paying attention to my account because I probably would have panic sold. So thank God for me being busy. November, however, bit of a rebound month. Value at the beginning was $48,000. Value at the end was $43,000. But remember, I have about $7,100 of unallocated cash. My profit and loss month over month was about just shy of $2,000, which was a 3.87% gain. And the profit or loss since open was about $410. So I made up all of the losses that I had. And yeah, essentially I'm back to basically break even. Now, why is that profit loss since open 410 and not including the about 4,000 in Amazon and Microsoft profits year over year? Because I'm just counting the profit or loss of my currently allocated cash. I'm not including things that have been realized at this point. So any dividends that were reinvested and not dividends that were pulled out, or any or anything that was reinvested after being sold. So I'm just including the cash basis versus what it is currently. Now, my plan for December, reinvest all of my dividends. If you remember from the beginning of the slide, it's a lot per quarter. Allocate the funds that I have from VOOG growth into ARC, especially before December 15th, and make my 2024 plan because I need to make my 2024 plan. Yep. So my December market diary will be much more forward-looking than previous-looking. So that should be a little bit more fun. Now, again, remember when I said reinvest my dividends? We're talking about $611 a quarter or $2,500 a year. That is a lot of dividend payments that I can put into these different stocks. Now, dividends, because most of these are not qualified dividends, they are income dividends. Most of them are taxed at my income rate and not at the qualified dividend rate, which would be less than my tax bracket. So that $25,000 is probably closer to $2,000 after taxes, maybe a little bit less, maybe $1,750. I don't know where I'll fall in 2024. But yeah, so it's still about $2,000 worth of dividends that I can pay into one of these stocks. And my goal is to get all of these stocks up to $10,000 and VOO up to $10,000. Once that's done, I will think about funding the small caps, but like I said, I'm not thrilled with them. I'm happy with them being a small part of my portfolio, so I have some exposure to small caps. But really, the main gain for 2024 is to make sure that Walmart, ENBRIDGE, Microsoft, and Amazon get up to $10,000 for total cost basis. So $2,000 from dividends, that is very that will go a very long way into helping that goal. at the very least, it gets ENBRIDGE up to 10 grand. So we'll see. And that's if no one else raises their dividends, because come January, a lot of these companies will readjust what their next 4 quarters will be, so they always allocate out a steady amount of dividends every year. I'm expecting ARC to go up to 51. I'm expecting Walmart to go up to 49.50. I'm expecting Walmart to go up to about 59.60. I'm expecting ENBRIDGE to be somewhere around 69.70. Like, I'm expecting essentially 3 cents on every single share is what I'm expecting from most of these companies. Anyways, I do want to remind you what my goals are and what my rules of engagement are. I am constantly breaking some of these rules because long-term capital gains only has not happened for any of the things I have sold. And if I had followed this rule, I would be in a much better position right now than I currently am. So I should probably remember to, follow my rules. I am keeping my portfolio diversified into 4 to 5 industries. I'm in 6 stocks and a couple of ETFs, so I'm happy with that. My dividends are over 3.5%. If you remember what it was here, I'm at about a 4.89, so I have beaten that. And yeah, I like my mix. I'm very happy with where I'm standing right now. So over the last, we're coming up on almost a year, so we're at the 3rd quarter mark of my market diary journey, because I started this in March of last year. I am very happy with where we're at right now, so we'll see how it goes in quarter 1, but right now I am very satisfied where I am at. As always, here are my disclaimers. Please, please, please read this, because I do not want you to think that any of this is financial advice. So take a look at this. Anyways, thank you very, very much for watching. I will see you guys all in December, and hopefully we have some fun times ahead. So happy holidays, Merry Christmas, all that fun stuff. I will see you in the new year. Bye, guys.